Good afternoon, I'm Dryden Pence. It's Tuesday, May the 4th, 2021, and this is our video. I'm going to talk a little bit today about the markets, the virus, policy, spending and taxes, the economy, and then as always, the so what. What does all of this mean for what's going on in this world around us? Well, first, the markets. Now, obviously, we're looking at volatility. We've had volatility, starting with the coronavirus and all of those things. We had the big dip in March, and then we climbed back out of it exceedingly well. And then now we've reached a little volatility. Here we are in May, and we're beginning to see some volatility come back into the market. Now, a couple of things that are important to know about this. We've climbed out, we've gone through this recovery. This is the fastest turnaround of the market in history from the dip that we had. But what does that mean? That means that a lot of people have made a lot of money in the stock market. And now what's happening is, because we're now a year past that big dip in March of last year. Now we're getting April, May, June, July, and then back into August, right? Because the peak, it went down and it kind of recovered back in August of last year, August 18th. We were fully recovered. So what does that mean? That means that between now and the 18th of August, you have a lot of people that are looking at their portfolios thinking this might be a good time to do what? To take capital gains, because they can now get long-term capital gains tax treatment. So as we see the market, we're going to have these moments of volatility for two reasons. One, people are trying to sell to take some capital gains that they have. And two, because there's proposals out there to raise the capital gains rate up to 39.6. Now, I'm going to just tell you real quickly, take a look at this chart. Anytime that the capital gains tax treatment has gone to 39.6, it hasn't stayed there for very long, and then it's gone back down. But again, this makes people curious and think about it. So tax policy may be affecting some volatility in the market. And the other thing is remember, we moved tax day from April 15th forward to May the 17th. And what happens every year right around tax day? You see some selling in the market, usually around 4% gets sold off. Because why? Because people have to pay their taxes. So what I want you to understand about market volatility between now and August is you're going to have some tax issues that are going to create a little more selling than might be there. Now, the other thing that's important is take a look at how much the market has run up. If you recognize that we really had these big recoveries of many sectors, right? When you look at the pre-pandemic high of February the 19th, or you can take a look at a trailing 12 months, the one-year number, or even year to date. So what's happened is the market has done very well. And that's triggered a lot of things, and things have to catch up. This is growth on the top. This is the Russell 3000 growth. And then value on the bottom kind of came up. They kind of came together here for a little while, and growth's taken off again. So what we begin to see this consistent movement forward in the market. People are going to react to tax strategies, but then the real big question is what's driving the market going forward? That's what's important. Now, also, take a look at that. In this chart, take a look at that dip we've had recently. What caused that? And I addressed this in the previous video, but I'll take a little deeper on it this time. Remember, we talked about supply chain problems, right? Supply chain problems. Well, this dip that you see came because interest rates went up, and people began to panic a little bit about that. Interest rates, or expected interest rates, went up a little bit, and so people kind of took it out of the tech sector. Well, why did that occur? It occurred because we had a backup in our ports, and our supply chains got out of whack, partly because of COVID, and partly because of this huge demand that came from online retail sales. So I talked about this last time. This was kind of the relational equation that was going on last time. You have supply constraints. That pushes prices up, right? Because when you don't have an oversupply of something, nothing goes on sale, right? How many times you try to buy something only to find out that it's on back order and you can't get it? Well, nobody puts back ordered products on sale. So sales are not happening so much. Prices are up. Well, that kind of passed its way through into inflation data, right? And so it looked like inflation was going up a little bit. Then everybody kind of panicked a little bit, and interest rates reacted to that. Here's the chart of the 10-year interest rate. You can see it kind of peaked up, right? And then now it's beginning to come back down. Why? Because the supply chain constraints are normalizing. Prices aren't going up quite as much. Expected inflation is not as much as people said it was, and then interest rates have reacted. So this is this graph that shows you kind of exactly what happened, what I was talking about last time. Now there's a second piece to the supply chain issue. We've talked a lot about pent-up demand. People have not been able to buy things, right? And so now they're getting out, the economy's recovering, people are recovering, they're getting out. So pent-up demand plus liquidity, right? People have a lot of cash, right? They had it from their savings, or they've been getting it from the Fed. Pent-up demand plus liquidity increase in aggregate demand. Well, more demand means higher prices, but it also translates into earnings, right? Companies are able to sell their products at higher prices, and that translates to earnings. So what you're seeing is second and third order effects of all this going on. And those expected higher prices have kind of worked their way through to earnings, right? 353 out of the S&P 500 have already reported, and 72% of those companies were beating sales, and 87% were beating on earnings expectations. So you can see as we come out of this, sales are higher, and most importantly, earnings are higher. So I think what you're going to see is we're going to have continued volatility in the market. It's going to bounce around right through August when we get past this kind of capital gains settlement issue that we're going to think. But what I see us having is what I call improving price quality. What do I mean by improving price quality? Prices in the stock market are a little bit high right now, but they're becoming more and more supported by earnings. So the prices themselves of the stocks kind of have a little better quality to them. And that's important. It helps you weather some of this upcoming volatility. Now let's move on. We're going to talk about stimulus versus the virus. Stimulus versus the virus. Well, we know that between everybody who's gotten it, plus getting vaccinated, plus recovering, in the United States, we're really kind of coming out of this thing reasonably well. And it is tragic the amount of lives that have been affected by this, both economically. It is tragic the number of lives that have been lost over this. But the point of the matter is we seem to be on the other side of it now. So things are every day getting better, not every day getting worse. And so the United States is recovering quite well. The European Union is a little bit behind us. And you think of us around the world, it looks like we're going to hit herd immunity in 2 or 3 months, but in Europe it's about 7 months. So we're really beginning to find ourselves where the U.S. is getting better faster than the rest of the world. And we've thrown a lot of stimulus at this. I mentioned this before. When you think about it, we have put more money into coronavirus recovery in the last year than we spent on all of World War II. That's a huge amount of money. We've thrown 25% of our nominal GDP right into the economy. It's a huge amount of stimulus. And what that's done is that's driven, right, GDP growth. It's driven this recovery, and a lot of people are really doing much better than they thought. Most people are doing much better today than they thought they would be doing if you asked that question 6 months ago. So the U.S. is going to find itself at a different normal faster than the rest of the world. We're recovering faster, plenty of liquidity. We're kind of coming out of this. So let's take it a little deeper on the economy. Well, when we think about this year, the first half of the year is about all this government stimulus that we put in. We think the second half of the year is going to be about pent-up consumer demand fueled by savings. People weren't spending that much money. They've saved a lot of money. Now they're getting out ready to shop it, and they have plenty of liquidity to do that. I'll show you that in a second. And then when we look at 2022, it'll be government stimulus versus taxes, right? It depends on what the tax policy looks like. But when we look at this year, this is the chart. Both savings and personal income now are at 30-year highs. People in this country, the household wealth has gone up tremendously, and household net worth has gone up tremendously. Remember, there's really two groups. Those that were dramatically affected by this, and then everybody else. And they really kind of break out in sectors. So what we've seen is while some people still need a tremendous amount of help, others have done reasonably well out of this. And that is translated into an economy that is growing, an unemployment rate that is falling, a GDP that is increasing, and a set of circumstances that things are far better now than they were 6 months ago. So let's talk about policies for the future. People get worried about the Federal Reserve and what the Fed is going to do, and what do they worry about interest rates and inflation. Well, the reason why people worry about interest rates or the inflation is they worry about the Fed raising interest rates. But you have to remember, the Fed wants inflation. They want inflation higher than 2%. That's why they keep saying we're going to keep interest rates lower for longer, right? They're going to want that because they want to keep the stimulus going, because they believe they need some inflation in the economy. So I don't think we see the Fed making any big changes the rest of this year. They're going to really kind of keep basically their foot to the floor on this, of increasing the money supply as they need to. Now let's talk about, so Fed policy is going to remain loose. They want us to have better than 2% inflation. Let's talk about fiscal policy. Now the Biden administration is putting forward a real big infrastructure push. They're calling everything infrastructure, but let's really talk about roads and bridges, because that's the piece of it that we actually think are going to get done. There's a certain amount of infrastructure that has to get done. So we really want to focus on roads and bridges, right? Because the bottom line is, let's focus on the infrastructure that if you don't fix it, people could die. That's what it comes right down to. And when you think about taking all of the deficient bridges that are structurally substandard in this country, and you line them up end to end, it would stretch from Seattle to Las Vegas. It's about 1,100 miles. We've got to do something about this. And so because it's so critical, I think that both political parties will be able to come to some accommodation on this. The Biden administration's plan and what they're putting forward has about $765 billion in it for this type of infrastructure, and then the Republicans' plan has about $800 billion in it. So we think that they're going to circle up and probably get at least roads and bridges done. And then there's the American Family Proposals, additional policy that Biden is putting forward. Again, massive stimulus continuing to flow into the economy. Now, I said before it was a variable speed recovery. Leisure and hospitality have been dramatically affected by this and the shutdowns and everything else. Many of the other different segments of the economy, less so. So we think we're going to continue to see a variable speed recovery. Some sectors are going to lag, others are almost fully recovered. And we see in the employment, that's beginning to grow back too. So we're almost back to where we were at the beginning, at the end of the Obama administration, and at the beginning of the Trump administration. So what's the big so what? What does all of this mean? It means that basically, like I said, we're going to see market volatility through August probably, because of all of the things that are going on. You've got capital gains coming in and people selling that. Then you also have tax liquidity here in May. But as we see this volatility, we also see that there's higher earnings coming. So as the market will maybe volatile on the top, earnings are making the quality of all the prices that we get a little bit better. That's a positive thing. We also see stimulus beating virus. First half is government spending, second half is consumer spending. So 2021 is about stimulus versus virus. 2022, it's going to be stimulus versus taxes, because some of this new stimulus will be coming in and the taxes will be the thing that we have to pay for. Now the Fed wants inflation. So there's going to be abundant liquidity in the market, and the market and the economy is going to continue to grow with unemployment falling. And we think the U.S. market prices, while they could be volatile here for the next couple of months, the quality is improving. In summary, the world is in a multi-speed recovery. The U.S. is recovering faster than the rest of the world. There's two things that happen. That's good for us here at home. It's good for our markets, good for our economy. It also gives us the opportunity to look outside the United States and look at Europe or Asia, South America, other areas that are recovering more slowly. But because it's all about the virus, it's all about the pandemic recovery and how much stimulus those economies can get, we'll probably have the opportunity later in this year, some in next year, to watch similar patterns in markets and economies in other parts and regions of the world. So that'll give us some opportunities as well. So I hope that this has been helpful. I want you to feel free to forward this video to your families and friends, and visit us at our website whenever you can. Thank you very much. you.